If you have a little bit of extra money right now, you are probably caught between three very different paths. You are either thinking about paying off your debt, putting that money into savings, or finally starting to invest. The difficult part about this is that none of these choices are objectively wrong, which makes the decision feel even heavier. It really depends on who you are, what you value, and how much you trust the math over your emotions. In this conversation, I want to walk you through exactly how I think through these decisions using a real example from my own life. I recently took on a car loan, and I want to show you the mental framework I use to decide whether to kill the debt or grow the assets. We are going to move past the surface level advice and look at the actual numbers that govern our financial freedom. I used to drive a 2006 Toyota Camry that belonged to my grandmother, and for a long time I had no car payment at all. But life changes, and I recently moved into a used car that came with a balance of $10,719. My monthly payment is $227. The term is 5 years, and the interest rate sits at 8.69%. Having a debt balance again feels a bit like a weight, but we have to look at it logically instead of emotionally. If I decide to be passive and just pay the minimum $227 every month for the next 5 years, the math is very clear. I would end up paying a total of $2,445 in interest alone by the time the loan is finished. That means a car that cost $10,719 today actually cost me over $13,000 in the long run. That 8.7% interest rate is a guaranteed cost. It is the price of waiting. Now, compare that to the alternative of paying the car off in just 6 months. To do that, I would need to put $1,786 toward the loan every single month. In that scenario, I only pay about $272 in total interest. By choosing the aggressive path, I am essentially saving myself over $2,100 in cold, hard cash. I know these numbers might feel small to some, but this is exactly how wealth is built or destroyed. One interest rate at a time. Interest is simply a time-based cost, and the less time the debt exists, the less power it has over your life. Think of it like rent for money. You aren't changing the price of the apartment. You are just moving out as early as possible. The reason I am leaning toward paying this off early is because that 8.7% is a guaranteed return. When we put money into the stock market, we often talk about an average return of 10% a year. But as we both know, the market does not give you a smooth 10% every single year. Some years it might drop 20%, and other years it might soar 30%. So there is always an element of risk. But when you pay off a debt with an 8.7% interest rate, you are getting a 100% guaranteed return on that money. There is no market volatility to worry about, and there is no chance of the debt going up if you pay it down. If my interest rate was 2 or 3%, I wouldn't even be filming this. I would just let the loan run its course and invest the rest. But at nearly 9%, the debt is working against me faster than I am comfortable with. I already have my emergency fund set up, which is the absolute prerequisite for any of this. Once you have that safety net, your goal should be to lower your fixed expenses as much as possible. The fewer obligations you have every month, the more freedom you have to take risks or pivot in your career. If you lose your job tomorrow, the bank does not care about your investment portfolio. They only care about that $227 payment. Reducing your monthly overhead is the ultimate form of financial insurance. However, there are very specific times when paying off a debt early is actually a mistake. The first reason is if it drains your emergency savings. You should never sacrifice your liquidity just to kill a loan, because a car paid in full won't buy you groceries if you lose your income. Keep that cushion of 3 to 6 months of expenses no matter how much the debt annoys you. The second reason to wait is if the aggressive payments create significant cash flow stress. If you are so focused on the debt that you have zero money left for a meal out or a small bit of joy, you will burn out. Financial discipline is a marathon, and if you sprint too hard at the start, you might not finish. The third reason is if paying off the car forces you to rely on credit cards for your daily expenses. Credit card interest is usually 20 or 30%, which makes a car loan look like a bargain. Never trade a mid-interest debt for a high-interest debt. That is a mathematical trap that is hard to escape. And finally, don't do it if it creates a crippling sense of anxiety or a total loss of flexibility. Wealth is supposed to provide peace of mind, not take it away. So when you are looking at your own situation, ask yourself 3 simple questions. First, do I have enough cash on hand to avoid panicking if something goes wrong? If the answer is no, then your only job is to save until that answer becomes a yes. Second, is my debt expensive or is it cheap? In my mind, anything over 6 or 7% is starting to get expensive and deserves your attention. If it is under 4 or 5%, it is relatively cheap. and you can probably afford to be more patient. Third, can I split my money instead of choosing just one path? If you have an extra $500 a month, you don't have to choose between only debt or only investing. You could put $250 toward the car and $250 into a low-cost index fund. This gives you the psychological win of watching your debt go down while your assets go up. None of these decisions have to be permanent, and you can change your strategy as your life evolves. For me, I am using the income from this channel to attack this car loan specifically. I still keep my regular investing schedule of $2,000 to $4,000 a month into my main portfolio. But any extra side income goes straight to the car because I want that liability off my balance sheet. It is a blessing to even have this choice, and I try to never lose sight of that. When I update my net worth next month, it will technically drop because I am adding this liability, but that is just a temporary dip on a long upward trajectory. The big picture here is that there is no universal right answer that fits everyone perfectly. Wealth building is less about finding the perfect optimization and more about making sustainable trade-offs. The best decision is simply the one that improves your position today without compromising your tomorrow. Financial progress is nothing more than flexibility combined with consistency over a long period of time. I am 26 years old, and I have learned that being boring with money is actually the most exciting thing you can do. It allows you to stop worrying about the price of things and start focusing on the value of your time. Whether you decide to pay off your car or buy your first share of an index fund, just make sure you are moving. The worst thing you can do is stay stuck in the middle, overthinking the math while the time slips away. Most people our age are looking for a shortcut or a secret algorithm to bypass the struggle, but I have realized it does not exist. I went from $0 to $120,000. Not by being a genius, but by accepting the math and staying disciplined. This is the first time in a while where I have looked around and felt uncomfortable about the economy. Inflation is cooling, but prices aren't going down, and people still feel broke because the gap is widening. Rent is up, groceries are up, and the dream of owning a home feels like a mathematical impossibility for many. The median American can no longer afford the median home, and the median age for a first-time buyer has jumped to 40. If you are making $45,000 a year, you are getting squeezed by forces that are larger than any one person. The next alarming trend is that total household debt is now over $17 trillion. Credit card balances are at record highs, and many people are one emergency away from breakdown. I am seeing job cuts hit levels we haven't seen in a long time, especially in the tech sector. This is a crisis because people are feeling higher prices and higher debt at the same time. I am not here to fearmonger. I am here to talk about building wealth despite the noise. I follow two simple rules: live within your means and invest what is left consistently. People got addicted to cheap money between 2008 and 2021, and they thought the market only goes up. That era of free money is over, and now companies are cutting back to protect their earnings. One easy way to cut expenses is to stop hiring or start firing, and the pressure is real. The housing market is also completely out of sync because people with low rates aren't selling, the inventory is low, and the supply isn't growing, which crushes the first-time buyer. Then we have the government debt, which is over $34 trillion and climbing. The options left are to raise taxes, print more money, or cut services, and none are easy. When confidence drops, spending changes, and the economy stalls. I see a few scenarios playing out, and one is a slow, brutal recession that lasts for a long time. The second is higher unemployment, as companies continue to lower their headcount to satisfy shareholders. We might also see a housing freeze where nothing moves until rates drop significantly. The Fed is terrified of an inflation spiral, so they might keep rates higher for longer than anyone expects. If you have watched this far, I want to talk about how you can protect yourself. You need to put yourself in a position to thrive while others are panicking. First, strengthen your own personal balance sheet by getting rid of high-interest debt. Avoid lifestyle creep at all costs. And if you get a raise, don't increase your spending. Second, try to become layoff-proof by building skills that are revenue-generating. Make yourself so valuable that replacing you would be a nightmare for your boss. Keep your network active before you actually need to use it. Third, use market volatility to your advantage by buying when things go down. Wealthy people buy assets when the middle class sells out of fear. Keep your investing simple and use dollar cost averaging into index funds. I invest every 2 weeks when I get paid, regardless of what the news says on the screen. Finally, focus on increasing your income because you can't just cut your way to wealth. Ask for a raise by showing the data of the value you provide to the firm. If that doesn't work, consider switching jobs every couple of years to reset your market value. The goal is to build a recession-proof life plan that relies on your own discipline. Live below your means during the good years so you can stack cash for the hard years. Don't make big emotional decisions when the economy is unstable. Every economic downturn in history has eventually led to more innovation and higher markets. Downturns are where the future millionaires are quietly built while no one is looking. I do think we are entering a challenging period, but that doesn't mean you are in danger. The people who stay disciplined will leap ahead of everyone who panicked and sold. Don't fear what is coming, just be prepared for it. I have gone from zero to having a portfolio of over $120,000 by age 26. It wasn't luck, and I didn't grow up with money in my pocket. My journey started in 2020 when the market tanked and everything was locking down. The S&P 500 dropped over 30% in a single month, and I was about to graduate. I was foolish back then and thought I could trade my way to wealth with options. I was basically gambling when I should have been building a foundation. I thought I was a genius for a few weeks, but it was just a hallucination before the market humbled me. After a couple of months of losing money, I realized that chasing excitement was the fastest way to stay poor. I switched to dividend growth investing because I wanted quality over hype. My biggest winners were companies that provide real value like Microsoft and Costco. I wasn't trying to 10 times MY money overnight. I was just looking for consistency. Eventually, I realized that picking individual stocks was taking up too much of my time. I switched to index funds because I wanted to win without having to watch the news every hour. No, my portfolio is mostly VU and SHE, and it is passive and it works. Nothing feels worse than seeing the market go up while your individual picks stay flat. The math shows that most people will underperform the index over a 10-year period. The first habit that got me here was living below my means. I still drive that old Camry because I don't care about flexing on people. I don't know. I tracked every single expense from my rent to my water bill. I was only making $55,000 a year when I started, so every dollar had to be managed. I avoided debt traps and credit card interest like the plague. When you look at my portfolio history, you will see that the amount doesn't matter as much as the habit. In some months, I only invested a few $100s, but I never stopped. The most important thing I can tell you is that the first 10,000 is the hardest. The increments move faster and faster as the snowball grows and gains weight. Between 2021 and 2022, my portfolio felt stuck for over a year. I was putting money in, but the market was flat and it felt like I was running in place. Most people quit there, but I knew the math was on my side. Then suddenly, it popped, and the balance started moving in leaps and bounds. If I put money in and the market goes up, I win. If I put money in and the market goes down, I get a discount on high-quality assets. It is incredible how people will run to a sale at a mall but run away from a sale in the market. If you have a long time horizon, a market crash is just a gift. Time in the market will always beat timing the market. I am 26 now, and even if I never invested another dollar, this would likely double many times. But I am not stopping. I want to see how far this discipline can take me. If you feel like it is too late to start, remember that the second best time is today. Start with $10 if you have to, just to build the muscle of paying yourself first. Wealth is not a mystery, it is just delayed gratification combined with basic arithmetic. Now let's talk about that first $1,000, because it is the most important milestone. Most people think $1,000 is too small to change anything, so they never start. But the first 1,000 is not about the money, it is about the psychology of ownership. It is about setting the trajectory for every single dollar you will ever earn. If you invest it right, it can compound into something way bigger than you imagine. The goal of the first 1,000 is to build habits that you can actually live with for decades. You are going to see how the market behaves and how you react when the red numbers appear. A lot of beginners treat $1,000 like a lottery ticket, but that is a mistake. You don't even have to invest it all at once, just do a little bit every week. Throw your money into an index fund and let the world's best companies work for you. These investments are boring, but boring is what actually builds wealth. By putting your money there, you are already beating the people chasing the next hot trend. Your biggest asset is time, and the difference between starting at 20 and starting at 30 is massive. Holding cash is not safe. It is a guaranteed loss because of inflation. The opportunity cost of sitting on the sidelines is actually quite high. The money won't make you rich tomorrow, but it will change the way you think about your work. The moment your money is invested, you stop thinking like a consumer and start thinking like an owner. That sense of responsibility leads to better decision-making in every other part of your life. That is why the first 1,000 is harder than the next 9,000. Real wealth is built on participation, not just on picking the right stocks. Quit waiting for a perfect moment that will never come. The compounding starts in your behavior before it ever shows up in your bank account. It is easy to talk about buying the dip when you have no skin in the game, but you don't know your risk tolerance until you see your own hard-earned money move against you. It is much better to learn these lessons with $1,000 than with $100,000. Most mistakes happen when people are emotional instead of logical. That first drawdown will teach you patience and conviction. Psychologically, losses hurt more than gains feel good, so train yourself to stay rational. Now, my portfolio moves quite a bit every week, and I wouldn't bat an eye if it dropped tomorrow. I would just keep buying because I understand the goal is to survive uncertainty. The headlines will tell you the world is ending, but the people who stay simple are the winners. Investing this money forces clarity and makes you choose a philosophy. Your framework determines when you buy and when you hold. I am a long-term investor. I don't sell based on market swings, and I never will. It is okay if your first investment isn't perfect because optimization comes with experience. Early investing should prioritize simplicity and consistency over everything else. Complexity creates hesitation, and hesitation is the enemy of progress. When things are simple, you create momentum, and momentum is what builds the snowball. Don't wait for guarantees because the market rewards participants, not spectators. The market is a judging machine in the short term, but a weighing machine in the long term. Your first investment is supposed to evolve as you do small mistakes. Now prevent catastrophic mistakes later. Don't trade options because turning 500 into 10,000 overnight is just a bad form of gambling. Slow compounding feels invisible at first, but it gets very loud once the numbers start to stack. I remember when I hit my first $1,000, and I realized it didn't take as long as I feared. That realization motivated me to find ways to save more and invest more. The best way to invest in 2026 is to get out of the sidelines and into assets that grow. History repeats itself, and the people who understand that stay calm while others panic. Regardless of what brokerage you use, just make sure you can buy fractional shares. That lowers the barrier to entry and keeps you from getting frustrated with high prices. Everything we have talked about today comes down to one thing: the courage to be boring. If you can manage the boring math and the slow progress, the numbers will eventually take care of themselves. It has been a long journey for me, but looking at that $120,000 balance, it was worth every sacrifice. I hope you start your own journey today, even if it is just with $10. Believe in the math, trust the process, and stay disciplined. I will be here to share the road to 200,000 with you very soon. I hope you found this conversation valuable. If you did, drop a like down below. Hit that subscribe button. I will see you in the next one. Peace.